Before we dive in, it is critical to state that the information in this video is for educational and informational purposes only. I am not a financial advisor, and this presentation is not a substitute for professional financial advice. The mortgage market is complex and your personal situation is unique. Always consult with a qualified and licensed financial professional or mortgage broker before making any decisions about refinancing your home. Imagine for a second that your mortgage is a subscription service, a really expensive one. You signed up years ago, got a decent deal at the time, and you've been paying it dutifully every single month. But what if I told you that over 70% of people with that same subscription are massively overpaying? What if the company offered a new, better, cheaper plan, but the sign-up process was so confusing, so intimidating that most people just don't bother? They just keep paying the higher price month after month, year after year, throwing away thousands of dollars. That isn't a hypothetical. That is the reality for millions of American homeowners right now. They are trapped by a decision they made years ago, completely unaware that they hold the key to unlock huge savings, simply because the process of refinancing feels like trying to read a foreign language in the dark. This is the video that turns on the lights. By the time you're done watching this, you will have a crystal clear step-by-step roadmap to understanding mortgage refinancing. We are going to demystify the jargon, expose the hidden fees, and give you the confidence to decide if refinancing is the single best financial move you can make this year, or a costly mistake to avoid. We will break down the pros, the cons, the risks, and the rewards, so you can stop guessing and start making an informed decision that could literally change your financial future. Because let's be honest, your mortgage is likely the largest debt you will ever have. Shouldn't you have the smartest, most efficient version of it possible? So what even is refinancing? Let's strip away all the complicated bank speak. At its core, refinancing is incredibly simple. You are just replacing your current home loan with a new one. That's it. You're trading in your old mortgage for a new one that hopefully has better terms. Think of it like swapping your old gas-guzzling car for a new fuel-efficient model. The new car still gets you from point A to point B, but it does it more efficiently and saves you money on gas every single week. Refinancing your mortgage aims to do the same thing for your finances. It keeps you in the same house, but it does so in a way that's healthier for your bank account. The new loan pays off the old loan completely, and you start making payments on the new one. The goal is to end up in a better position than where you started. Now, people do this for a handful of reasons, but they almost always fall into one of three major categories. Think of these as the big three motivations for refinancing. The first, and by far the most common reason, is to get a lower interest rate and, as a result, a lower monthly payment. This is the classic no-brainer scenario. If interest rates in the market have dropped since you first got your loan, you have a golden opportunity. Even a seemingly tiny drop in your interest rate can have a massive impact. Let's run some real numbers. Say you have a $400,000 mortgage on a 30-year fixed loan at a 6.5% interest rate. Your monthly principal and interest payment would be about $2,528. Now let's say market rates have dropped, and you can refinance that same loan amount to a new 30-year loan at 5.5%. Just 1 percentage point lower. Your new monthly payment would be $2,271. That's a savings of $257 every single month. That's over $3,000 a year. That's a vacation. That's a serious boost to your retirement savings. That's your kids' braces. Over the life of the loan, that 1 percentage point could save you over $92,000 in interest. It is a monumental difference, all from making one smart move. This is about reducing your monthly financial pressure and freeing up cash flow for other things, whether it's investing, saving, or just breathing a little easier at the end of the month. The second major reason people refinance is to change the term of their loan. The term is just the length of time you have to pay it back, typically 30 years or 15 years. This isn't about the interest rate as much as it is about your long-term life goals. Maybe you got a 30-year mortgage when you first bought your house because you needed the lowest possible monthly payment. But now you've gotten a raise, you're more financially stable, and the idea of being in debt for another 25 years makes your stomach turn. You can refinance from a 30-year loan into a 15-year loan. Now, your monthly payment will almost certainly go up, maybe even by a lot. But here's the trade-off. You will pay it off in half the time, and you will save an astronomical amount in total interest. You build equity at lightning speed and achieve the incredible goal of owning your home free and clear decades sooner. Conversely, maybe the opposite is true. Maybe you started with a 15-year loan, but now you've had kids, or you want to start a business, and your monthly cash flow is tight. that high payment is suffocating you, you can refinance back out to a 30-year loan. This will lower your monthly payment dramatically, giving you that much-needed breathing room. Yes, you'll pay more interest in the long run and you'll be in debt longer, but sometimes winning the monthly cash flow battle is more important than winning the long-term interest war. It's about adjusting your biggest financial obligation to fit the current season of your life. And that brings us to the third major reason, and this is the one that is both the most powerful and potentially the most dangerous: tapping into your home's equity. This is often called a cash-out refinance. Over the years, as you've paid down your mortgage and as your home's value has hopefully increased, you've built up equity. Equity is the portion of your home that you actually own. It's the difference between what your home is worth and what you still owe on the mortgage. A cash-out refinance allows you to unlock that wealth. You take out a new, larger loan that pays off your old mortgage and gives you the difference in a tax-free lump sum of cash. Let's use an example. Your home is now worth $500,000, and you only owe $250,000 on your mortgage. You have $250,000 in equity. You could refinance for a new loan of $350,000. That new loan pays off the old $250,000, and you walk away with a check for $100,000 in cash. People use this money for all sorts of big-ticket items. A massive home renovation to build that dream kitchen, paying for a child's college education without taking out student loans, consolidating high-interest credit card debt into one lower-interest mortgage payment, or even buying a second investment property. It can be an incredibly strategic tool to leverage the asset you live in to achieve other financial goals. But it is also a double-edged sword. You are increasing your total debt and using your home as collateral. This is where people can get into serious trouble if they treat their home like an ATM without a solid plan. So those are the big three: lower your payment, change your loan term, or cash out your equity. They are the fundamental reasons why someone would even start this journey. But here's the critical question that stops most people dead in their tracks. How do you actually know if it's the right move for you right now? It's not as simple as just looking at the day's interest rates. In fact, focusing only on the interest rate is one of the single biggest and most costly mistakes you can make. There are hidden costs, break-even points, and crucial timing factors that almost no one talks about, but that can make or break your decision. And that is exactly where we're going next. So let's start with the single most important calculation you will ever make when considering a refinance, a number so critical that it should be the very first thing you figure out, yet it's often the last thing people think about if they think about it at all. It's called the break-even point. This is your magic number. It's the North Star that tells you whether refinancing is a brilliant financial move or a catastrophic mistake. To understand it, I want you to think of your mortgage not as a single continuous debt, but as a 30-year video game. Every month you make a payment, you're leveling up. You're defeating a little bit of the interest monster and gaining experience points in the form of equity. You've been playing this game for, say, 5 years. You're on level 60 out of 360. You've made real progress. Refinancing is like hitting the reset button on that game. You get a new, updated version of the game. Maybe with better graphics, a lower difficulty setting in the form of a lower interest rate, but you're starting back at level 1. All that progress you made specifically on the 30-year timeline? Gone. You're now facing a brand new 30-year journey. The problem is, hitting that reset button isn't free. There's a cost to start the new game, and those are your closing costs. Your break-even point is the exact moment in time when the money you save each month from your lower payment finally adds up to equal the amount you paid in closing costs. It's the point where you go from being in the red on this decision to being in the black. Here's the simple math. You take your total closing costs and you divide them by your monthly savings. The number you get is the number of months it will take to break even. Let's put some real numbers on this. Imagine your closing costs are $6,000. And by refinancing, you're going to save $300 a month on your payment. You take $6,000, you divide it by 300, and you get 20. It will take you 20 months, almost 2 years, just to pay back the cost of getting the new loan. For the first 19 months, you haven't actually saved a single penny. You've just been paying yourself back for the fees you paid up front. The real savings only begin in month 20. Now, here's the million-dollar question that derails so many people. What happens if you sell your house before you hit that break-even point? What if you get a job offer in another state, or your family grows and you need a bigger place and you decide to sell at month 18? You've lost money. Period. You paid $6,000 in fees and only recouped $5,400 in savings. You would have been better off never refinancing in the first place. You literally paid the bank thousands of dollars for nothing. This is why knowing how long you plan to stay in your home is not a trivial detail. It is the entire foundation of the decision. If you're not confident you'll be there long past your break-even point, you should stop right here. Don't pass go, don't collect $200. So, what are these closing costs that are so important? They are the gauntlet of fees you have to run to get to the finish line. Lenders love to gloss over these, but they can be substantial, typically running anywhere from 2 to 5% of your loan amount. On a $400,000 loan, that could be anywhere from $8,000 to a staggering $20,000. These aren't just one or two little charges. We're talking about an army of fees. There's the loan origination fee, which is basically the lender's commission for doing the deal. There are application fees, processing fees, and underwriting fees, all different names for the administrative work of putting your loan together. There's the appraisal fee, where you pay someone a few $100 to come out and confirm your house is actually worth what you say it is. You'll have title search and title insurance fees, to make sure there are no hidden claims or liens on your property. There are recording fees you pay to your local government to make the new loan official. Sometimes there are attorney fees, survey fees, pest inspection fees. The list can feel endless. Now you've probably seen the ads that scream, "No-cost refinance." Let me be crystal clear. There is no such thing as a no-cost refinance. It is a marketing myth. It's like a restaurant offering a free lunch, but charging you $20 for a glass of water. The costs are still there, they're just hidden. A lender can hide them in one of two ways. They can roll the closing costs into your loan balance, which means you're now paying interest on those fees for the next 30 years. Or, more commonly, they'll offer you a slightly higher interest rate in exchange for a lender credit that covers your costs. Either way, you are paying for it. Do not fall for the illusion of a free lunch. This brings us to one of the biggest traps for amateur refinancers: focusing only on the interest rate. The interest rate is the big shiny number that lenders dangle in front of you. It's the headline. But savvy borrowers know to ignore the headline and look at a different number entirely: the APR, or annual percentage rate. The interest rate is just the cost of borrowing the money. The APR is the true cost of the loan because it includes not just the interest rate, but also most of the closing costs and fees we just talked about spread out over the life of the loan. Here's the best analogy. The interest rate is the sticker price of a car. The APR is the out-the-door price. You'd never buy a car just by looking at the sticker price, because you know there's going to be sales tax, a destination charge, dealer prep fees, and a dozen other line items that jack up the final cost. The APR is that final out-the-door number for your mortgage. When you're comparing offers from different lenders, comparing them by interest rate alone is a rookie mistake. Lender A might offer you a 6.5% interest rate, while Lender B offers 6.75%. You think Lender A is the obvious choice. But then you look at the fine print. Lender A is charging you $10,000 in closing costs, while Lender B is only charging $3,000. When you look at the APR, Lender B's loan might actually be the cheaper option over the long run. Always compare loans using the APR, not the interest rate. It's the only way to get a true apples-to-apples comparison of what you're actually paying. So, the first pillar of a smart refinance is a cold, hard look at the numbers. Calculate your break-even point. Are you certain you'll be in the house long enough to make it worthwhile? Get a loan estimate from any potential lender. They are legally required to give you one, and scrutinize the closing costs. And finally, compare your offers using the true cost, the APR, not the flashy interest rate. But let's assume you've done all that. You've run the numbers. Your break-even point is 3 years and you plan to stay in your home for at least another 10. The savings are substantial. Seems like a slam dunk. Is it time to sign on the dotted line? Not even close. Because we've only looked at the math of the new loan. We haven't considered the hidden power you're giving up on your old loan. There's a ticking clock, a powerful force working in your favor on your current mortgage that gets completely reset to zero when you refinance. Ignoring this can make refinancing one of the worst financial decisions of your life, even with a fantastic new rate. And that is exactly what we need to dismantle next. Let's pull back the curtain on how a mortgage really works. Imagine your 30-year mortgage isn't a straight line to freedom. It's a heavily tilted seesaw. For the first several years, the bank is sitting on the high end, and you're stuck on the ground. Almost every dollar you send them in your monthly payment is being gobbled up by interest. A tiny, almost insulting amount is trickling down to pay off the actual money you borrowed, the principal. This is called amortization, and it is, by design, brutally front-loaded with interest. Think about it. A $400,000 loan at 6.5% interest has a monthly payment of about $2,528. In your very first month, a staggering $2,167 of that payment is pure interest going straight into the lender's pocket. Only about $361 actually chips away at your $400,000 debt. You're basically renting money from the bank at this stage. But here's the magic that happens over time. As you keep making payments year after year, the seesaw slowly starts to level out. The amount going to interest shrinks, and the amount going to principal grows. By year 5, you're paying about $2,050 in interest and $478 in principal. Better, but still heavily skewed. By year 10, you're at $1,880 in interest and $648 in principal. You're starting to build some real momentum, and then you cross the halfway point. Around year 17, for the first time ever, more of your payment is going towards your own home equity than to the bank's bottom line. From that point on, you are on the winning side of the seesaw. Your equity starts to build at an incredible accelerating rate. In your final years, almost your entire payment is pure principal, crushing your debt with every check you write. You've endured the hard part, and now you're reaping the rewards. Now here comes the refinance offer. A shiny new lower interest rate. You've been paying your mortgage for 7 years. You've endured 84 payments, you've paid over $178,000 in interest, and you've finally started to make a tiny dent in your principal. You're just getting to the good part where the seesaw starts to tilt in your favor. But when you refinance back into a new 30-year loan, you are literally taking that seesaw, flipping it all the way back to the beginning, and putting the bank right back on top. You are volunteering to go back to month 1. Let's make this painfully clear with a real-world scenario. Meet David. 7 years ago, David bought his home with a $500,000 mortgage at a 7% interest rate for 30 years. His monthly payment is about $3,327. For 7 years, he's paid diligently. He's paid a total of $279,468 to the bank, but his loan balance has only gone down by about $46,000. That means over $233,000 of his hard-earned money has vanished into thin air as interest payments. He's furious, but he's weathered the storm. He now has 23 years left on his loan. A lender calls him with a fantastic offer. David, we can get you a new rate of 5.5%. We'll lower your monthly payment and save you money. They're not lying. His new payment on a new 30-year, $454,000 loan would be just $2,578. That's a savings of $749 every single month. Feels like a no-brainer. He signs the papers, celebrates his lower payment, and feels like he just won the lottery. But what did he really do? He just extended his sentence. He had 23 years left. Now he has 30. He just added 7 years of payments onto his life. Let's do the math the lender conveniently left out. On his original 7% loan, over the full 30 years, David was on track to pay a total of $697,555 in interest. It's a horrifying number, but it's a finite number. Now let's look at his new path. He already paid $233,000 in interest over the first 7 years. On his new 5.5% loan, over the next 30 years, he will pay another $474,000 in interest. Add those two numbers together. His new grand total of interest paid is over $707,000. He refinanced to a lower rate to save money, but he will actually end up paying an extra $10,000 in interest over his lifetime, and he will be in debt for 7 additional years. He traded a lower monthly payment for a longer financial prison sentence. This is the amortization trap, and millions of Americans fall for it every single year because they only focus on the monthly payment, not the total cost. The entire system is designed to keep you in that interest-heavy part of the loan for as long as possible. Every time you refinance back to a 30-year term, you are willingly stepping back into the bank's favorite part of the game. So how do you beat it? How do you get the benefit of a lower rate without falling into the trap? You do it by refusing to reset the clock. Let's rewind. David has 23 years left on his mortgage. When the lender calls, David should say, "That 5.5% rate sounds great, but I'm not doing another 30-year loan. Quote me for a 20-year loan, or even a 15-year. He should match his new loan term to be shorter than what he currently has left. Let's see what happens if David refinances his $454,000 balance into a 20-year mortgage at that same 5.5% rate. His new monthly payment would be about $3,178. Now notice something crucial. This payment is only about $150 less than his original payment of $3,327. It doesn't give him that huge, exciting monthly savings of $749 that the 30-year refi offered. This is why lenders rarely push this option. It's less sexy, it's less marketable, but it is infinitely more powerful. By choosing the 20-year term, David will pay off his house 3 years earlier than he was originally scheduled to. And the total interest he'll pay on this new loan is just $308,000. Remember, he already paid $233,000 in interest on the old loan. So his new lifetime interest total is $541,000. Let that sink in. By choosing the 20-year refinance instead of the 30-year, David saves himself over $166,000 in interest payments and gets out of debt 3 years faster. By forgoing a little extra cash in his pocket each month, he fundamentally changes his financial future. He builds equity faster, he owns his home sooner, and he keeps a life-changing amount of money for himself and his family instead of handing it over to the bank. This is the single most important concept to understand about refinancing. The rate matters, but the term, the length of your loan, is the weapon that determines who wins. Resetting your loan term is almost always a losing move. Shortening it is how you turn the tables on the lenders and use refinancing as a tool for building wealth, not just for temporary monthly relief. But even if you master the amortization game and pick the perfect loan term, there's another giant, cash-draining monster hiding in the fine print of every refinance deal. They're called closing costs, and they can easily devour every single penny you thought you were saving. And that is the next trap we need to expose. Think of closing costs as the financial equivalent of an iceberg. The monthly savings you see advertised? That's the tiny sparkling tip you see above the water. The closing costs are the massive, ship-sinking block of ice hiding just below the surface. Lenders love to talk about the tip of the iceberg, but they're a lot quieter about the part that can wreck your financial future. So what exactly are you paying for? These aren't just random fees. They are a long list of charges, each with a specific and often self-serving purpose. First up, the application and origination fees. This is basically the lender charging you for the privilege of them doing their job, processing your paperwork and creating the loan. It's like paying a cover charge to get into a store where you're about to spend $500,000. Next, you've got the appraisal fee. This is a big one, often several $100s. You pay a professional to come to your house and determine its current market value. Now, you might think this is for your benefit, to confirm your home is worth what you think it is. But you'd be wrong. The appraisal is almost entirely for the lender's protection. They need to make sure that if you default on the loan, the house they're about to take back is actually worth enough to cover their investment. You're paying to reassure your bank. Then comes the flood of other charges. There's title insurance, another fee that primarily protects the lender against any old claims or liens on your property's title. You'll pay for a credit report even though you can get your own for free. You might pay for flood certification, tax service fees, and courier fees to shuffle all this paper around. If you use a lawyer or an escrow company, and you almost certainly will, their fees get added to the pile. Individually, they might seem small, $100 here, $50 there. But together, they create a financial death by 1,000 cuts. So how big is this monster? Typically, closing costs run anywhere from 2 to 5% of the total loan amount. Let's put that in real numbers. If you're refinancing a $400,000 mortgage, you're not looking at a small administrative fee. You are looking at a bill between $8,000 and a staggering $20,000. That's a reliable used car. It's a year of college tuition. It's a life-changing amount of money that you have to pay right now just for the opportunity to save a couple $100 a month down the road. And this is where the first layer of the trap snaps shut. People get so hypnotized by the lower monthly payment that they completely ignore the massive upfront cost. They save $300 a month, and their brain stops there. They don't do the math to see that it might take them years just to pay back the cost of getting the loan in the first place. But wait, I can hear you thinking it now. What about all those ads? The ones that scream, "No closing costs," from your TV and radio. Surely that's the perfect solution, right? A free lunch. This is perhaps the most deceptive marketing gimmick in the entire mortgage industry. Let me be perfectly clear. There is no such thing as a no-cost refinance. It does not exist. It is a myth. A financial unicorn. The costs are always there. The only question is how the lender is going to hide them from you. They have two main tricks, two little bits of financial sleight of hand. The first option is to roll the closing costs into your loan principal. So, if your closing costs are, say, $7,000, and you're refinancing a $300,000 loan, your new loan won't be for $300,000. It will be for $307,000. The lender happily pays all those fees for you, and then tax them onto your mortgage balance, where they will sit collecting interest for the next 30 years. You didn't avoid the cost, you just agreed to finance it, turning a one-time fee into a long-term debt. The second and even more subtle trick is a higher interest rate. The lender will say, "Sure, we'll waive the closing costs." But the interest rate they offer you will be a quarter, a half, or even a full percentage point higher than the best market rate. They know that over the life of the loan, that slightly higher rate will make them far more money than the few $1,000s they waived in closing costs. It's like a car dealership offering you free floor mats, but secretly charging you $5,000 extra for the engine. You feel like you got a deal, but you've actually been taken for a ride. So, how do you disarm this trap? How do you know if a refinance is a brilliant financial move or a costly mistake? You have to do the one calculation that most homeowners never bother with. It's called calculating your break-even point. This is the single most important piece of math in the entire refinancing process. It's simple. You take your total closing costs and you divide them by your monthly savings. The number you get is the number of months it will take for the refinance to actually start saving you money. Let's run through an example. Imagine your closing costs are $6,000, and your new, refinanced mortgage saves you $200 per month compared to your old one. You take $6,000 and divide it by $200. The answer is 30. It will take you 30 months, 2.5 years just to break even. For the first 30 months of that new loan, every penny you saved is just going straight back to the bank to pay off the cost of the refinance. You don't see a single dollar of real savings until month 31. Now you have to ask yourself a very serious, very honest question. Am I absolutely certain I will still be living in this house in 2.5 years? Because if you get a new job, if you have another child and need to upsize, if any of life's curveballs force you to sell that house before you hit your break-even point, you have officially lost money on the deal. You handed the bank $6,000 for nothing. You paid a massive fee for a few months of slightly lower payments, and the bank walks away with your cash. Let me tell you about a hypothetical couple. We'll call them Mark and Jessica. They had a $450,000 mortgage at 4.5%. A lender called them up, offered them a no-cost refinance at 3.75%. Their payment would drop by $350 a month. They were thrilled. They signed the papers without reading the fine print. The lender had used the first trick. They rolled the $9,000 in closing costs into the loan. Mark and Jessica's new loan balance wasn't $450,000, it was $459,000. They didn't really notice. All they saw was that extra $350 in their checking account each month. Felt like a huge win. But 18 months later, Jessica got a fantastic job promotion in another state. They had to move. When they sold their house, they were shocked. After paying off the mortgage, the amount they had left over was thousands of dollars less than they had calculated. Why? Because that hidden $9,000 was still sitting in their loan balance, plus the interest it had accrued. Over those 18 months, they had saved $6,300 in payments. But it cost them $9,000 to do it. They lost $2,700 on a deal they thought was a no-brainer. They fell right into the trap. This is the reality of closing costs. They are the gatekeeper to refinancing. And if you don't calculate your break-even point and honestly assess how long you'll be in your home, they will turn your dream of savings into a guaranteed financial loss. So you've navigated the closing costs minefield, you've calculated your break-even point, and you're ready to move forward. But now you're faced with a new, tantalizing offer from the bank. They don't just want to lower your rate, they want to give you a giant pile of cash. It's called a cash-out refinance, and it's one of the most tempting and potentially destructive financial tools available to a homeowner. It can build empires, or it can lead straight to foreclosure. So how does it work? How does your house, this collection of wood, drywall, and memories, suddenly become a source of liquid cash? It's simpler and more seductive than you might think. Imagine you bought your home for $300,000 10 years ago. You've been diligently paying your mortgage, and now you only owe $200,000. At the same time, the housing market in your area has been on a tear. Your home is now appraised at $500,000. The difference between what your home is worth, $500,000, and what you owe, $200,000, is your equity. In this case, $300,000. That's your wealth, locked inside the walls of your home. A cash-out refinance allows you to take out a brand new larger mortgage loan to replace your old one. Lenders will typically let you borrow up to 80% of your home's current value. In our example, 80% of $500,000 is $400,000. So the bank says, we'll give you a new loan for $400,000. The first thing you do with that money is pay off your old $200,000 mortgage. Poof, it's gone. What's left? $200,000. That money is wired directly to your bank account. Tax-free. Feels like you just won the lottery. But you didn't. You just signed up for a much larger debt, secured by the one thing that keeps a roof over your head. The question is, what do you do with that $200,000? This single decision is what separates the empire builders from the people who lose it all. Let's talk about building an empire first. The smartest use of a cash-out refinance is to invest that money into something that will generate a higher return than the interest rate on your new mortgage. You are, in effect, borrowing at, say, 6% with the goal of making 8, 10, or even 20% on that money. The most direct way to do this is by investing back into the asset you borrowed against, your home. I'm not talking about putting in a new hot tub or a fancy home theater. I'm talking about strategic renovations that have a proven return on investment. A major kitchen remodel can often recoup over 80% of its cost in added home value. Finishing a basement to create a legal rental unit doesn't just add value. It creates an entirely new income stream that can help pay down that bigger mortgage faster. You could use that $200,000 to add a new story to your house, effectively doubling your square footage and potentially increasing its value by far more than the cost of the renovation. In these cases, you're not just spending money. You're strategically deploying capital to increase the value of your primary asset. You're using debt to create more equity. That is a classic wealth-building move. The second powerful use is debt consolidation. Let's say on top of your mortgage, you're juggling $20,000 in credit card debt at a crippling 22% interest rate, and another $30,000 in a personal loan at 12%. You're being bled dry by interest payments every month. With a cash-out refi, you can take $50,000 of that $200,000 and wipe those high-interest debts off the map in a single afternoon. You've just swapped 22% and 12% debt for a single consolidated debt at your new mortgage rate of, say, 6%. Your monthly cash flow will dramatically improve. The money you were throwing away on interest can now be used to save, invest, or pay down your new mortgage even faster. This can be a brilliant financial reset button, but it comes with a terrifying psychological trap. Once you pay off those credit cards, you now have $20,000 of available credit again. If you don't have the discipline to cut those cards up and change your spending habits, you will end up with a bigger mortgage and maxed out credit cards a year later. You'll be in a deeper hole than ever before. The third, and most ambitious, path is using the cash to invest outside your home. This is where real empires are built. You could use that $200,000 as a down payment on 2, or even 3 rental properties. You're using the equity in your primary residence to acquire more income-producing assets. You're leveraging your home to build a real estate portfolio. Or maybe you have a brilliant business idea you've been dreaming of for years, but you've never had the startup capital. This cash-out could be the seed money that launches a multi-million-dollar company. It could be used to pay for a child's college education, investing in their future earning potential, which is an asset with an immeasurable return. These are the high-risk, high-reward plays. You are literally betting the house. If your business fails or your rental properties sit vacant, the bank doesn't care. They just want their mortgage payment every month. And that brings us to the dark side. For every person who uses a cash-out refinance to build wealth, there are countless others who use it to accelerate their path to financial ruin. It starts with a simple thought. I've been working so hard. I have all this equity. I deserve to enjoy it. So they pull out $75,000. They buy a brand new $35,000 SUV because the old one was starting to have problems. They spend $25,000 on a dream vacation to Europe, posting every moment on Instagram. The last $15,000 goes to new furniture, high-end electronics, and designer clothes. For a few months, life feels amazing. They feel rich. But they aren't rich. They've just converted their home equity, a stable, appreciating asset, into a pile of rapidly depreciating liabilities. The car loses value the second it leaves the lot. The vacation becomes a memory. The furniture gets scuffed. But the $75,000 increase in their mortgage? That lasts for 30 years. They've essentially signed up for a 30-year payment plan for a 2-week vacation. This is the most common and devastating mistake. treating your house like an ATM to fund a lifestyle you can't actually afford. What people fail to grasp is the sheer brutal cost of this over the long term. Let's say you were 10 years into your original 30-year mortgage. You had 20 years left. When you do a cash-out refinance, the clock resets. You now have a new 30-year mortgage. You just turned a 20-year loan into a 30-year loan. You've added a decade of payments to your life. On a $400,000 loan at 6%, that extra decade could easily cost you over $200,000 in additional interest payments. Think about that. You pulled out cash today, but you will end up paying the bank back double or even triple what you borrowed over the life of the new loan. It is anything but free money. Finally, there's the ultimate risk that no one wants to think about: a housing market crash. When you pull cash out, you are increasing your loan-to-value ratio. You're shrinking that equity cushion that protects you. Let's go back to our example. Your home is worth $500,000, and you now have a new $400,000 loan. Your loan-to-value is 80%. But what if the market corrects? What if your home's value drops 25%, down to $375,000? Suddenly, you are underwater. You owe the bank $400,000 for a house that's only worth $375,000. You have zero equity. You are trapped. You can't sell without bringing cash to the closing table. You can't refinance. If you lose your job or have a medical emergency and can't make the payments on that inflated mortgage, foreclosure becomes a very real, very terrifying possibility. This isn't a scare tactic. This is the exact scenario that destroyed millions of American families in 2008. They used their homes as personal piggy banks during the boom years, and when the market turned, they lost everything. So before you get tempted by that giant pile of cash, you have to ask yourself one brutally honest question. Am I an empire builder, or am I just funding a lifestyle? Because your home will give you the rope. It's up to you whether you use it to pull yourself up or to hang yourself. So let's talk about that rope. Because when you do a cash-out refinance, the bank hands you one end, and what you do with it defines the next 30 years of your financial life. Let's imagine two neighbors, living in identical houses, both worth $500,000. They both owe $200,000 on their current mortgage. And they both get the same idea at the same time. Let's tap into that equity. They both go to the bank and get a new loan for $400,000, cashing out $200,000 in tax-free money. Their monthly payment goes up, their loan term resets to 30 years, and they each walk away with a check for $200,000. This is the fork in the road. This is where the story splits. Our first neighbor, let's call him Empire Builder Ed, sees this money not as a windfall, but as ammunition. He's been studying his local real estate market for months. He knows there's a demand for multifamily rentals near the local college. He takes that $200,000 and uses it as a down payment on an $800,000 fourplex. He's done his homework. He's run the numbers. The mortgage on the new property is, say, $4,000 a month. But the total rent from the 4 units is $5,000 a month. So right off the bat, that property is generating $1,000 in positive cash flow. Now let's look back at his personal house. His mortgage payment went up by, let's say, $1,200 a month because of the cash-out refinance. But the new investment property is giving him $1,000 a month. So, in reality, he is only paying an extra $200 out of his own pocket each month. But what did he get for that $200? He now controls an $800,000 asset. An asset that someone else, his tenants, are paying off for him. An asset that is appreciating in value. An asset that provides tax benefits. He used the rope his first house gave him to lasso a second, bigger asset. He pulled himself up. He is building an empire, one brick at a time, funded by the smart use of debt. Now let's look at his neighbor, Lifestyle Larry. Larry gets his check for $200,000, and his mind goes wild with possibilities. He's always wanted a backyard oasis. So he spends $80,000 on a beautiful in-ground pool and a custom deck. The kitchen has been bothering him for years, so he drops another $70,000 on a full gut renovation with high-end appliances. With the remaining $50,000, he buys his wife a brand new luxury SUV, and they take the family on a $10,000 trip to Hawaii to celebrate their good fortune. For a few months, Larry's life is amazing. He's the king of the neighborhood. He's hosting pool parties. He's cooking in a chef's kitchen. He feels rich. But then the bills start coming. His property taxes went up because of the improvements. His homeowner's insurance increased because of the pool. The new SUV needs premium gas and more expensive insurance. And, most importantly, his mortgage payment is now $1,200 higher every single month for the next 30 years. Unlike Ed, Larry has no new income to offset this. He didn't buy an asset, he bought expenses. He bought a lifestyle. That $200,000 is gone, vaporized into things that are either depreciating in value like the car, or costing him more money to maintain like the pool and kitchen. He used the rope his house gave him to tie a beautiful, but incredibly heavy anchor around his own neck. He's not building an empire. He's just digging a deeper hole in his own backyard. This is the classic, most obvious trap of the cash-out refinance. You turn your home, your greatest asset, into a 30-year payment plan for a vacation you took last summer. It's financial quicksand. But there's another more subtle and, in my opinion, far more dangerous trap. It's the one that feels smart. It's the one that financial gurus sometimes even recommend. And that is using a cash-out refinance for debt consolidation. The pitch is so seductive, it's almost impossible to resist. Let's say you've racked up $50,000 in high-interest debt, credit cards at 24%, a personal loan at 12%. You're getting crushed by minimum payments, just treading water. Your monthly payments on all this debt are, let's say, $1,500 and the balances barely move. Then a lender comes along and says, "Hey, you have all this equity in your house. Let's do a cash-out refi. We'll pull out $50,000, pay off all those toxic loans in one fell swoop, and roll that balance into your new mortgage at a nice low 6% interest rate." Let's look at the math, because the math is intoxicating. Your new mortgage payment might only go up by $300 a month, but you've just eliminated $1,500 a month in other payments. You've just freed up $1,200 in cash flow every single month. Feels like you just got a massive raise. You feel brilliant. You feel responsible. You took 24% debt and turned it into 6% debt. You've won the game, right? Wrong. For most people, you've just set the board for catastrophic failure. Because you didn't fix the problem. The problem wasn't the interest rate on your credit cards. The problem was the habit that got you $50,000 in credit card debt in the first place. Refinancing doesn't perform surgery on your spending habits. All it does is wipe the slate clean. It gives a compulsive spender a fistful of empty zero-balance credit cards. And what does a person with a spending problem do with an empty credit card? They see it as an invitation. So the cycle begins again. A small purchase here. An emergency there. A vacation because, hey, we have all this extra cash flow now. And slowly but surely, over the next 2 or 3 years, those credit card balances start to creep up again. Before you know it, you're right back where you started, with $50,000 in high-interest debt. But now the situation is infinitely worse. Because you still have the larger mortgage from the last time you did this. You took $50,000 of unsecured debt that, if you defaulted, a credit card company would have a hard time collecting, and you transformed it into secured debt. You've now attached that old shopping spree directly to the deed of your house. You've given the bank the power to foreclose on your home because of a spending habit you never fixed. You didn't get rid of the debt, you just moved it to a more dangerous location. You didn't solve the problem, you just refinanced it. This is the ultimate illusion of progress. You feel like you're taking a giant leap forward, but you're just walking on a treadmill that's been placed at the edge of a cliff. The only way debt consolidation via a cash-out refi works is if you fundamentally change your relationship with money. It requires a level of discipline that the vast majority of people who rack up that much consumer debt simply do not have. You have to be willing to take the credit cards you just paid off, put them in a drawer, and never touch them again. You have to commit to living on a budget and using that $1,200 in newfound cash flow to aggressively save and invest, not to create a new, higher level of lifestyle spending. So you have to be brutally honest with yourself. Are you Empire Builder Ed? Or are you Lifestyle Larry? And if you're thinking about debt consolidation, are you truly ready to perform radical surgery on your financial habits? Or are you just looking for an easy way to keep the party going? Your answer to that question will determine whether refinancing is the smartest decision you ever make, or a trapdoor to financial ruin. And the truth is, most people never even get to make that choice consciously. They're so blinded by the promise of a lower rate or a big check that they completely overlook the price of admission. Because before you can even decide which path to take, you have to pay the toll. And that toll, the closing costs, can be a brutal, deal-killing surprise that most people never see coming. Let's peel back the curtain on these closing costs, because they are the single biggest reason a seemingly brilliant refinance plan completely falls apart. Think of it like this: you find an incredible deal on a flight online. Price is amazing. You get all the way to the final checkout screen, And suddenly you're hit with a seat selection fee, a baggage fee, a convenience fee, and a dozen other charges that jack up the price by 30%. That feeling of frustration and betrayal? That's exactly what opening your first loan estimate can feel like, except instead of $100, we're talking about thousands. So what are you actually paying for? These costs aren't just one single fee. They're a collection of charges from different players involved in the transaction. Typically, you can expect closing costs to be anywhere from 2 to 5% of your total loan amount. On a $300,000 refinance, that means you could be on the hook for $6,000 to $15,000 out of pocket before you save a single penny. The first fee you'll almost always see is the loan origination fee. This is the lender's paycheck for doing the work, processing your application, underwriting the loan, and handling all the paperwork. It's usually a percentage of the loan amount, often around 1%. So, on that $300,000 loan, you're already looking at a $3,000 fee right off the bat. Next up is the appraisal fee. The bank that's giving you this new loan needs to make sure the house is actually worth what you say it is. After all, the house is their collateral. If you stop paying, they need to know they can sell the house and get their money back. So they hire an independent appraiser to come out, inspect your property, compare it to similar homes in the area, and put an official value on it. This typically costs a few $100s, somewhere in the $400 to $600 range. And here's the kicker. You pay for it whether the loan goes through or not. If the appraisal comes in low, killing the deal, that money is gone. Then you have the murky world of title services. This one confuses a lot of people. You'll see charges for a title search and title insurance. A title search is basically a background check on your property. Someone goes through all the public records to make sure there are no hidden claims or liens against your home. They're making sure you are the undisputed legal owner and that nobody from the past, a long-lost heir of a previous owner, an unpaid contractor, can suddenly show up and claim a stake in your property. Title insurance protects the lender against any errors in that search. It's a one-time premium, but it's mandatory. You can't get the loan without it. This bundle of services can easily add another $1,000 or more to your bill. We're not done yet. You'll likely have attorney fees or settlement fees, paying the professional who sits at the table and makes sure all the I's are dotted and T's are crossed. There are recording fees, which is what you pay the county or local government to officially record your new mortgage in the public record. There might be a credit report fee, a flood certification fee. The list goes on. Each one might seem small, $100 here, $50 there, but they add up like a death by 1,000 cuts. But the biggest and most strategic closing cost you might face is something called discount points. And you need to understand this one perfectly. 1 point costs 1% of your loan amount. So on our $300,000 loan, 1 point is $3,000. What does paying this $3,000 get you? It gets you a lower interest rate. You are essentially prepaying some of the interest upfront in exchange for a lower rate for the entire life of the loan. Sometimes paying for points makes a ton of sense. Other times it's a terrible financial mistake. And this brings us to the most important calculation in the entire refinancing process. It's the one thing that separates a savvy financial decision from a costly error. It's called the break-even point. The break-even point is the precise moment in time when your monthly savings have officially paid back your closing costs. After this point, every dollar you save is pure profit in your pocket. Before this point, you're still in the red. The formula is beautifully simple. Just take your total closing costs and divide them by your monthly savings. Let's run the numbers. Imagine your total closing costs, including the origination fee, appraisal, title, and everything else, come out to $6,000. And let's say you're new. Refinance mortgage saves you $300 every month compared to your old one. You take $6,000 in costs and divide it by $300 in savings. The answer is 20. That means it will take you 20 months just to break even. For a year and a half, every bit of that $300 you're saving is just going back to pay off the cost of getting the loan in the first place. Only on month 21 do you actually start realizing a true financial benefit. Now, why is this number so critical? Because it forces you to answer the most important question of all. How long are you realistically going to stay in this house? If you plan on living there for the next 10 years, a 20-month break-even point is a no-brainer. You'll have over 8 years of pure savings. But what if you think you might get a job transfer in 2 years? What if you're thinking of upgrading to a bigger house in 3? Suddenly, that refinance looks a lot less attractive. If you sell the house before you hit your break-even point, you have effectively lost money. You paid thousands of dollars in fees for a benefit you never had time to realize. This is the trap. People get so hypnotized by the lower monthly payment that they don't do the break-even math. They sign the papers, pay the $6,000, and then 18 months later life happens. They have to move. They end up selling the house having saved only $5,400 on their payments, meaning they took a $600 loss on the deal, not to mention all the time and hassle. Now, you've probably heard the seductive marketing pitch for a no-cost or zero-cost refinance. It sounds like the perfect solution, right? All the benefits of a lower rate with none of the upfront pain. But you have to understand there is no such thing as a free lunch in the mortgage world. Those costs don't just vanish. The lender is still paying the appraiser, the title company, and their own loan officers. They're just hiding the cost from you in one of two ways. First, they might offer you a slightly higher interest rate. Instead of the 6% rate that comes with closing costs, they'll offer you a no-cost loan at 6.5%. That extra 0.5% you pay every single month for the life of the loan is how they recoup their costs, and then some. Over 30 years, that higher rate could cost you tens of thousands of dollars more than if you had just paid the closing costs up front. The other method is to roll the closing costs into your loan principal. So if you're refinancing a $300,000 loan and the costs are $6,000, your new loan balance will be $306,000. You didn't have to bring cash to the table, but you just increased your total debt and you'll be paying interest on those fees for decades. A no-cost refinance isn't a scam, but it is a trade-off. It's a tool that can be useful for someone who wants to save money monthly, but doesn't have the cash on hand for closing costs. But you have to go into it with your eyes wide open, knowing that you are absolutely 100% paying for it in the long run. So you've done the math. You've calculated your break-even point, you've weighed the options of paying points, and it all looks good on paper. Seems like a clear win. But what the spreadsheet and the calculator don't tell you is the hidden trap of time itself. By refinancing, you're not just changing your payment. You are often resetting a 30-year clock. And that simple act of restarting the timeline can secretly cost you tens of thousands of dollars more than you ever imagined, even with that shiny new lower rate. Let's break down exactly how this works, because it's a concept I call the amortization illusion. When you first get a mortgage, your payments are heavily front-loaded with interest. For the first several years, the vast majority of your monthly payment isn't building you equity. It's just going straight into the lender's pocket. You're barely chipping away at the actual loan balance. It's like trying to run up a down escalator. You're putting in a ton of effort, but you're not making much upward progress. The real principal paydown magic doesn't start to happen until years 10, 15, and beyond. Now, imagine you've been diligently making payments for 5 years. You've endured that brutal interest-heavy phase. You've paid tens of thousands of dollars in interest, and you're just starting to reach the part of the escalator that's flat, where every step you take actually moves you forward. Then an offer to refinance comes along. Lower rate, lower payment. It sounds fantastic. So you sign the papers. What you've just done is step off the escalator you were 5 years up, walk all the way back to the bottom, and step onto a brand new 30-year long down escalator. You are starting that brutal interest-heavy phase all over again. Let's put some real numbers on this, because this is where the illusion becomes a cold, hard financial reality. Let's say you bought your house 5 years ago with a $400,000 mortgage on a 30-year fixed loan at a 6% interest rate. Your monthly principal and interest payment would be about $2,398. Over those first 5 years, you would have made 60 payments totaling about $143,880. Now you'd think you've made a good dent in your loan, right? Wrong. Of that nearly $144,000 you paid, a staggering $117,000 of it was pure interest. Only about $27,000 actually went to paying down your loan. So after 5 years of payments, your remaining balance is still a whopping $373,000. This is the moment the refinance offer appears. A lender says, "Hey, we can get you a new 30-year loan at 4.5% on that $373,000 balance." You run the numbers. Your new monthly payment would be about $1,890. That's a savings of over $500 a month. $500. That's a car payment, a serious boost to your savings, a family vacation. Feels like an absolute no-brainer. This is the bait, and it is incredibly tempting. But you've just fallen into the trap. You've reset the clock. You were 25 years away from owning your home free and clear. Now you're 30 years away. You've extended your total time in debt from 30 years to 35 years. So let's look at the total cost. On your original loan, over the remaining 25 years, you were on track to pay about $346,000 more in interest. But with the new refinanced loan, over its 30-year term, you will pay a total of $307,000 in interest. First glance, that looks like a win. You saved on interest, right? Not so fast. You forgot about the $117,000 in interest you already paid during the first 5 years of the original loan. So the grand total is this. With the original loan, your total interest paid over 30 years would have been about $463,000. With the refinance, you paid $117,000 in the first 5 years, and now you'll pay another $307,000 over the next 30 years. Your new grand total for interest is $424,000. So you did save about $39,000 in total interest. That's not nothing. But here's the kicker you're completely ignoring. You added 5 full years to your mortgage. 5 years of your life where you will be sending a check to the bank instead of investing that money, saving for retirement, or living freely. What is 5 years of financial freedom worth to you? Is it worth $39,000? For some, maybe. But for most, the goal is to get out of debt, not to stay in it longer, even at a slightly lower total cost. You're trading 5 years of your life for what amounts to a discount of about $650 per year. The bank is winning that trade every single time. They get to keep you on the hook, paying them interest for an extra 60 months. This is the hidden cost of resetting the clock. You're so focused on the shiny object, the lower monthly payment, that you don't see the long-term consequence. More years in debt. So how do you avoid this trap? How do you get the benefit of a lower interest rate without sacrificing years of your financial life? The answer is to fight the timeline. You do this by refinancing to a shorter-term loan. Instead of going from a 30-year loan into another 30-year loan, you look at refinancing into a 20-year or even a 15-year mortgage. Let's revisit our example. You're 5 years in, you have a $373,000 balance, and you have 25 years left on your 6% loan. Your payment is $2,398. Instead of refinancing to a new 30-year loan, what if you refinance that $373,000 into a 15-year fixed loan at an even better rate, say 4%? Lenders typically offer lower rates for shorter-term loans. Your new monthly payment would be about $2,759. Okay, I hear you. The payment went up by about $360 a month. That sounds terrible, right? This is where you have to separate short-term thinking from long-term wealth building. Yes, your monthly cash flow is a bit tighter, but look at what you've accomplished. First, you've shaved 10 years off your mortgage. You went from having 25 years left to just 15. That is a decade of your life you just bought back. A decade of not having a mortgage payment. Second, the interest savings are astronomical. On that 15-year loan, the total interest you'd pay is only about $123,000. Let's compare the total interest paid from this point forward. Option A, keep the old loan. You pay $346,000 more in interest over 25 years. Option B, refinance to a new 30-year loan. You pay $307,000 more in interest over 30 years. Option C, refinance to a 15-year loan. You pay $123,000 in interest over 15 years. By choosing the 15-year refinance, you save over $220,000 in interest compared to your original loan. You are building equity at lightning speed. You're not just servicing debt, you are actively destroying it. This is the single most powerful move a homeowner can make during a refinance. You are turning the tables on the bank. Instead of them tricking you into staying in debt longer, you are using their lower rates to get out of debt faster than you ever thought possible. But what if you can't afford that higher payment for the 15-year loan? What if that extra $360 a month just isn't in the budget? There's a powerful hybrid strategy. You can still take the 30-year refinance to lock in that low 4.5% rate and get the low required payment of $1,890. This gives you flexibility and a safety net. But then, you treat it like a 15-year loan. You use a mortgage calculator to figure out what the 15-year payment would be. We know it was $2,759, and you voluntarily pay that amount every single month. Or if you can't swing that, you pay whatever extra you can. An extra $100, $200, $500. You make sure that extra payment is designated to go directly toward the principal. By doing this, you get the best of both worlds. The security of a low required payment if times get tough, but the financial discipline to pay it off dramatically faster when you can. You'll still save a fortune in interest and cut years off your loan, all on your own terms. The key is discipline. The bank is betting you won't have it. They're betting you'll see that extra $500 a month and spend it, keeping you on their books for the full 30 years. Mastering this timeline game is absolutely crucial. It's the difference between a refinance that genuinely helps you build wealth and one that secretly keeps you running on the interest treadmill for years longer than necessary. But even if you get the timeline right, there's another minefield you have to navigate. A world of upfront charges and hidden fees that can devour your potential savings before you even begin. These are the closing costs, and failing to understand them can turn a great deal into a financial disaster. Let's pull back the curtain on this financial labyrinth. Closing costs are essentially the cover charge for getting into the refinancing club. They are a collection of fees paid to all the different parties who have a hand in creating your new loan. We're talking about the lender, the appraiser, the title company, and sometimes even the government. On average, you can expect these costs to run anywhere from 2 to 5% of your total loan amount. So, on a $400,000 refinance, you could be looking at a bill between $8,000 and $20,000. That's a staggering amount of money, and it's precisely why so many people get cold feet. But fear isn't your enemy here. Ignorance is. Let's demystify this beast fee by fee. First, you have the lender's fees. This is what you pay the bank for the privilege of them lending you money. The biggest one is often the loan origination fee. Think of this as the lender's commission for doing all the paperwork, underwriting the loan, and processing your application. It's typically around 1% of the loan amount. So on that same $400,000 loan, that's a $4,000 fee right off the bat. Some lenders might also charge a separate, smaller application fee, just to get the ball rolling. Now this is where it gets interesting. You'll hear the term points, or discount points. This is one of the most misunderstood parts of any mortgage. Each point typically costs 1% of your loan amount, and in exchange the lender will lower your interest rate. You are essentially prepaying interest to get a lower monthly payment for the life of the loan. Let's say your rate is 7%. The lender might offer you the option to buy 1 point for $4,000 to drop your rate to 6.75%. Is it worth it? That depends entirely on how long you plan to stay in the home. It's a gamble on your own future. You have to calculate how many months of savings it will take to earn back that $4,000 upfront cost. If you sell the house before you hit that break-even point, you've just given the bank a very generous tip. Next up are the third-party fees. These are costs for services provided by people other than your lender, but they are required to get the deal done. The first one you'll encounter is the appraisal fee. The bank is not going to just take your word for it that your house is worth what you say it is. They need to protect their investment. So they hire an independent appraiser to inspect your property and determine its current market value. This fee can run anywhere from $400 to over $1,000, depending on your location and the complexity of your property. Then there's the credit report fee. It's usually small, maybe $30 to $50, but it's the cost for the lender to pull your credit scores and history from the major bureaus. This is non-negotiable. Then we enter the world of title services. This is a big one. You'll see a charge for a title search and title insurance. What is this? Well, the title company does a deep dive into the property's history, scouring public records to make sure there are no hidden claims, liens, or ownership disputes attached to your home. They're looking for ghosts in the legal machine, a long-lost heir, an unpaid contractor's lien, a clerical error from 50 years ago that could call your ownership into question. The title insurance is a policy that protects you, and more importantly the lender, from any of those ghosts coming back to haunt you later. It's a one-time fee, but it can be hefty, often costing over $1,000. You'll also likely see attorney fees or settlement fees, which are paid to the lawyer or closing agent who handles the final paperwork and ensures the transaction is legally sound. Finally, you have the government's cut. These are the prepaid taxes and insurance, often called escrow or impounds. Your new lender will require you to prepay a certain amount of property taxes and homeowners insurance upfront, which they'll hold in a special account to pay those bills on your behalf when they come due. This ensures the property, their collateral, is always protected. You'll also have to pay recording fees. This is the fee your local government, usually the county, charges to officially record your new mortgage in the public record, making it official. It's usually a couple $100, but it's the government's way of putting their official stamp on your new debt. Now, you've probably seen the ads that scream, "And no closing cost refinance." It sounds like the deal of a lifetime, a financial unicorn. But let me be perfectly clear. There is no such thing as a free refinance. It's a marketing gimmick, a clever sleight of hand. The costs don't just vanish into thin air. Instead, the lender gives you two options to hide them. Option 1. They roll the closing costs into your loan principal. So if your closing costs are $10,000, they just add that to your mortgage balance. You're not paying it out of pocket, but you are now paying interest on that $10,000 for the next 15 or 30 years. Option 2, and this is more common. The lender offers you a higher interest rate in exchange for a lender credit that covers your closing costs. So instead of a 7% rate, they might offer you a no-cost loan at 7.5%. They're betting you'll stay in the loan long enough for them to make back those costs, and then some through the extra interest you're paying them every single month. It's a classic shell game. The money always comes from somewhere, and it's always coming from you. So how do you make sense of all this? How do you decide if paying thousands of dollars in fees is actually worth it? The answer lies in a simple but powerful calculation: your break-even point. This is the single most important number in the entire refinancing process. To find it, you take your total closing costs and divide them by your monthly savings. Let's walk through it. Say your total closing costs after shopping around come to $7,000. And let's say you're new. Refinance mortgage payment will be $250 lower than your old one. You take $7,000 and divide it by 250. The answer is 28. That means it will take you 28 months, almost 2.5 years, just to pay back the cost of getting the loan. Every month after that is pure savings, pure profit in your pocket. But if you think there's even a small chance you might sell your home or move within those first 28 months, then refinancing is a losing proposition. You would have spent $7,000 just to end up losing money. Understanding this break-even point transforms you from a passive consumer into an empowered decision-maker. It cuts through all the sales pitches, all the confusing jargon, and boils the entire decision down to one critical question: will I be in this home long enough to make the upfront costs worthwhile? You now have the tools to dissect the fees, to question the no-cost myth, and to calculate your own financial tipping point. You've learned how to spot the hidden traps and understand the true price of admission. But knowing the cost is only half the battle. Now you have to face the lenders themselves, a world of negotiation, paperwork, and critical choices that can make or break your entire financial future. So you've navigated the maze of closing costs, you've crunched the numbers on your break-even point, and you're ready to step into the ring. What happens now? You are about to enter the most critical phase of the entire process: the lender gauntlet. And the single biggest mistake, the one that costs homeowners thousands of dollars, happens right here at the very beginning. It's the mistake of loyalty. You might love your current bank, you might have been with them for 20 years, but when it comes to refinancing, loyalty can be incredibly expensive. Your bank is counting on you to just take their offer. It's easy. It's comfortable. It's also very likely not the best deal you can get. The first rule of refinancing is simple and non-negotiable. You must shop around. This isn't like buying a coffee. This is one of the largest financial transactions of your life. Not getting at least 3 to 5 quotes is like walking onto a car lot and just paying the sticker price on the first car you see without even looking at another dealership. You wouldn't do it. So where do you shop? You need to cast a wide net. Get a quote from your current lender, yes. Get a quote from another large national bank. Get a quote from a local credit union, which often have fantastic rates and lower fees for their members. And absolutely get quotes from reputable online mortgage lenders and brokers. A mortgage broker can be a powerful ally because their job is to shop your application to dozens of wholesale lenders, many of whom you'd never have access to on your own, to find the best possible deal. Now, when you start applying, something incredible happens. Within 3 business days of each application, federal law requires every single lender to send you a standardized 3-page document. It's called the loan estimate. This document is your secret weapon. It was designed after the 2008 financial crisis specifically to prevent lenders from hiding fees, and to empower you, the consumer, to compare offers apples to apples. Don't be intimidated by it. Go straight to page 1. You'll see the loan amount, the interest rate, and the monthly principal and interest payment, clear as day. This is your first point of comparison. But don't stop there. Look for the APR, the annual percentage rate. The APR is often slightly higher than the interest rate because it includes not just the interest, but also many of the lender fees and closing costs, averaged out over the life of the loan. The APR gives you a more holistic view of the true cost of borrowing. A loan with a slightly lower interest rate but sky-high fees might actually have a higher APR than a competitor. Then flip to page 2. This is where the magic happens. Under loan costs, you'll see a detailed breakdown of all the fees. Section A, the origination charges, is pure lender profit. This includes things like application fees, underwriting fees, and processing fees. This is the section you have the most power to negotiate. Section B is for services you can't shop for, like the appraisal and credit report. But Section C is for services you can shop for, like the title search, title insurance, and settlement agent. Armed with these loan estimates, you are no longer a passive customer. You are a negotiator in a position of power. Lenders are competing for your business. Take the best offer you have from lender A and call lender B. Be direct. Say, I have a loan estimate here from another lender with an interest rate of X and total fees of Y. I prefer to work with you. Can you beat this offer? You will be absolutely stunned at how often they can and will. Suddenly, that non-negotiable $1,000 underwriting fee might get waived. They might offer you a lender credit, which is basically them giving you money to apply toward your other closing costs in exchange for a slightly higher interest rate. Sometimes this makes sense, sometimes it doesn't, but now you have the options and the information to make that choice. Once you've negotiated the best possible deal, you have one more critical decision to make: locking your interest rate. A rate lock is a guarantee from the lender to hold a specific interest rate for you for a set period, typically 30, 45, or 60 days, while they process your loan. This is your shield against the volatility of the market. If interest rates shoot up 0.25% the day after you lock, it doesn't matter. Your rate is protected. But the lock is a double-edged sword. If rates drop significantly after you lock, you're generally stuck with your higher rate. Some lenders offer a float-down option, allowing you to get the lower rate if the market moves in your favor, but this often comes with an upfront fee. The length of the lock also matters. A 30-day lock might be free, but if you need a 60-day lock because your situation is more complex, the lender might charge you for it, often in the form of a slightly higher interest rate. In a volatile market, locking your rate as soon as you have an offer you're happy with provides peace of mind and protects you from a sudden spike that could sabotage your entire refinance. And so, we arrive at the end of this journey. We've dismantled the myths, we've navigated the math, we've uncovered the hidden costs, and we've faced the lenders. But after all of this, the final question remains the most important one: should you do it? Let's bring it all home. Refinancing is not a goal in and of itself. It is a tool. Powerful one, but just a tool. The goal is what that tool allows you to build. If you're a family struggling with a high monthly payment, feeling the squeeze every time an unexpected bill arrives, refinancing to a lower rate isn't just about saving a few $100s. It's about creating breathing room. It's the freedom to say yes to piano lessons. It's the peace of mind of being able to build an emergency fund. It's about reducing financial stress so you can be more present with your family. If you're a homeowner sitting on a mountain of equity while being crushed by high-interest credit card debt or student loans, a cash-out refinance isn't just a financial transaction. It's a reset button. It's consolidating all those stressful, expensive debts into a single, manageable, lower-interest payment. It's a strategic move to slay the dragon of debt and accelerate your journey to financial freedom. If you're in your forever home and you're 10 years into a 30-year mortgage, refinancing to a 15-year term is not just about changing your loan documents. It's a declaration of intent. It's deciding that you want to own your home free and clear 5 years sooner. It's about saving tens or even hundreds of thousands of dollars in interest over the life of the loan and building true, unencumbered wealth for your retirement and your legacy. But this tool is not right for everyone, and it's not right for every situation. If you're planning on selling your home in the next 3 to 5 years, the closing costs will almost certainly outweigh any monthly savings. Don't do it. If your credit score has dropped significantly since you first bought the house, you likely won't qualify for the top-tier rates that make refinancing worthwhile. Wait, rebuild your credit, and then attack. If the only way to make the numbers work is to stretch your loan term back out to 30 years after you've already paid for a decade, you must be brutally honest about the massive long-term interest cost of that decision. Ultimately, refinancing your mortgage is one of the most significant financial levers you can pull. It's a decision that can alter the course of your financial life for decades to come. It's not about chasing the lowest possible rate headline you see on the internet. It's about understanding your own unique financial picture, your goals, your timeline, and your priorities. It's about doing the math, asking the hard questions, and negotiating with confidence. You now have the framework. You have the knowledge. You understand the pros, the cons, the traps, and the opportunities. Your home is not just a place to live. It is the foundation of your financial world. And managing the debt on that home with intention and strategy is the key to building a future of security, freedom and choice. The power is in your hands. Use it wisely.